I must say I'm in my old age reaching a point where I have a little trouble convincing myself that the stock market is that important, and that we live in an age where some much more important issues are playing out. But I view the stock market now really as a hobby. And the one thing that I have kept going is resources and climate change related investing, and also, for old time's sake, investment bubbles, since I've been doing that for 40 or 50 years. And since I find myself unexpectedly in the third great investment bubble of my career, basically in the US. So I can't avoid it. And this is a wonderful day to be having this discussion. It's not only Victory Over Hitler in Russia Day, but it's also a day where the market is showing signs of breaking down. Through yesterday, it's the worst opening of a year for the S&P since I was 1 year old in 1939. I am a pre-war baby, unlike Ray. And of course, the NASDAQ is down as we speak, 27.5% from its high, and the Russell 2000 about 23, S&P about 15.5. So it's getting to be interesting. And as we were saying before, Bitcoin from some point in the last 24 hours is down 10% to 32,000 and change. So that is getting interesting. And ARK, Kathy Wood's wonderful instrument, is back to it where it was in 2018. I'm not kidding you. It is back below this entire event now, which is quite remarkable, down 75% from its peak, as is AMC, down 75% from its peak. And the other meme stocks are in ragged disarray. So this is the real McCoy, seems to be playing out pretty close to 2000. Always considered myself a fairly serious amateur historian. And what I've done in bubble territory is I don't try and build models to explain every day, as you guys do. I focus on the four great bubbles, which are characterized by nearly hysterical behavior, really seriously weird over-optimism, which is very rare, and which are characterized by accelerated price moves on the upside, and by a weird deviation on the upside between the blue chips going up and the risky stocks going down. And that is rare as hen's teeth. It happened brilliantly in 29. It happened during the year 2000, again in spades, with the S&P X growth continuing to go up through September of 2000, and the growth stocks basically going down 50%, and the internet stocks dropping maybe 60, 70% by then. So that was spectacular. And we saw a very handsome deviation between the S&P rising last year and the Russell 2, for example, dropping quite handsomely. So there was a 20, 25 point spread on the upside. And that for me is a pretty good indicator. And I tell you what it describes. It describes Mr. Prince's "I've got to keep dancing because the music's still playing." And we understand that completely, the enormous commercial imperative of the industry to play up to and over the edge. But they're not complete idiots. And so they say, well, I've got to keep dancing, but I don't have to keep dancing with Pumatech, the most advanced stock in 99. I'm going to transfer to Coca-Cola. and I'll keep dancing it off the edge, but I'll go off with Coca-Cola. And it works. The Coca-Colas may be handsomely overpriced, but in 1929 and 2000, 2001, and so on, they always go down a lot less as the bubble breaks. And that's the phenomenon that causes this very rare indicator of impending doom, which we saw last year. And so by early this year, it seemed clear to me that this was not only the real McCoy bubble, which had been clear for a year or so in terms of pricing and enthusiasm, but it had triggered this very rare indicator of impending doom, in other words, now. And so our piece of a year and a bit ago was called Waiting for the Last Dance. And our equivalent follow-up this January was Let the Wild Rumpus Begin, i.e. we're in it, dudes. And I do believe we are. And I believe the declines will be very substantial. We have a market today which feels superficially like 2000. And I think it's going to play out initially like 2000. And then, unfortunately, is going to phase, as he suggests, into the 70s, where the deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today. A word on inflation, too. I completely agree with Ray on the short-term problems, which I would summarize as monetary and general Federal Reserve overstimulus for 30, 35 years, the war and COVID, all of those three influences guaranteeing that we have a relatively intractable problem in the short to intermediate term. What worries me is the longer term arguments for inflation, which is one, we are running out of people. In China, where the 500 million extra farmers precipitated globalization, they have now had diminishing cohorts of 20-year-olds for 20 years. And they are guaranteed, since they're alive now, we know the baby cohorts are dropping like a stone. They are simply going to have a shortage of labor, as is the developed world together. That is not a trivial block, the developed world plus China. All of them will be squeezed for labor. After the bubonic plague, they had a 100-year honeymoon period in which wages went up so much it wasn't reached for another several hundred years in the Industrial Revolution. And we are entering a period where labor is simply scarce, which feels to me inflationary. And at the same time, we have a scarcity beginning in resources. And we keep an original, unusual index at GMO. It's 36 equal weighted, important, the most important commodities. So it's not dominated by oil. And it showed a declining pattern for 102 years, from 1900 to 2002. And yes, it was interrupted by World War I and World War II and OPEC. Why wouldn't it be? But it wanted to go down. It went down 70%. It took the index down to 30. Today, 122 years later, the index is down 10%. It has gone to 90. The average important commodity has just spent the last 20 years going from 30 to 90. It has tripled. The reason is, of course, the growth of China, but I believe, fairly passionately looking at the data, that it also represents the intrinsic scarcity, the war between deeper wells, worse iron ore, etc. The best go first. The struggle is always between technology, which for 100 years got ahead of scarcity. It was 2 paces down for deeper and 3.5 paces up for technology. And now we've reached a phase where we've gone through that stuff. And now we have 2 paces up for technology and 3 paces down for scarcity. The data is screaming at us now for 20 years that we're beginning to run out. It doesn't, and a war, of course, and COVID. We're so fragile. All you have to do is cough now, and it ricochets around the world in price spikes and shortages and bottlenecks. And that is the world we better get used to living in. We're going to have a world of increasing number of bottlenecks and shortages. And the same applies to food. The UN Food Index is higher today than any time in its history of the last 50 years, since it started. Okay, so you have price pressure on raw materials, metals, food. You have price pressure long-term on labor. This surely feels like a new era in which inflation will be part of the background music, just like it was in the 20th century, and perhaps more so. The risks of a debt bubble breaking and the risks of an equity bubble breaking have simply not been understood by our Federal Reserve since Paul Volcker. They are incredibly naive. They haven't even got a clue. They're not even interested in the idea. The idea, Bernanke saying, oh, the US housing market has never declined. It merely reflects a strong US economy. Alan Greenspan encouraging, et cetera, right through until today. They don't realize that they're playing with such fire. My second point, high levels of debt are just far too often seriously dangerous and should be, in general, discouraged actively. That should be one of the responsibilities of top management, including the Fed, et cetera. And let me just give you an example. Why do you like low rates? Because it encourages debt. Why do you like more debt? Because it encourages growth. That's the argument. So let me give you the ultimate statistical test of that. We start in 1985, and we have been modestly increasing the debt to GDP ratio, all debt together, just drifting slightly up due to technology. And then the technology, I mean the introduction of more and more sophisticated financial instruments, but not rising dramatically. And then in 85, it kills to a 45-degree angle and shoots across any page and goes from about 1.1 times GDP to well over 3. So in that little window of 35 years, we triple the debt to GDP ratio. It's a big chunk of time. It's the biggest, most important economy on the planet, a pretty good test. So what happens to growth? It inflects downwards. And from 85, we grow more slowly. Grant you, there are many other factors at work. It's a complicated picture, but there is little room in that equation for the idea that more debt creates more growth. It is not proven in the data. It is held to be the case. It is an assumption like most of modern economics, but it is not proven by the data. I would suggest that there is no evidence at all that increased levels of macro debt to GDP have anything to do with growth. They have everything to do with higher risk, though, from time to time. When we're selling our resource portfolio, we have a wonderful exhibit that looks at the correlation between all the major sectors, utilities, consumption, and so on, consumer goods. And there's only one where, as the time period lengthens, the correlation drops, and that is resources. And resources drops to such good effect that based on the last 80 years of data, every rolling 10-year period, that the 10-year correlation is negative. So if you believe in inflation, you know that resources do very well. You also know that in the long run, it's strongly negative. It's negatively correlated modestly with the rest of the portfolio. As we're seeing today, when they do well, it puts a burden on the rest of the economy and they do bad. So there is a very strong case here for a resource portfolio. On resources, just a point that the last time we had a super bubble in commodities, there were very large new mines waiting to come online. What has happened since the 2011 crunch, when China slowed down in its heavy industrializing, and the growth rate for iron ore and coal dropped from double digit to zero, dead flat for 3 years in a row, breaking the back of the resource industry. They have not done any capex. It takes 5 to 15 years to bring on a mine. They have not been doing this. There are no great reserves of lithium, cobalt, copper, nickel, even iron ore to come online this time. And everybody knows it. If you look at the need for these, particularly green metals, greening metals, it doesn't compute. There are no backup resources. And that applies right across the length and breadth of resources. They have not been capexing, even in oil and gas, for the last 10 years, to a remarkable degree. I think the world has simply been running way over its capacity. And the great luxury of the last 200 years of fossil fuels, coal and then oil and gas, have catapulted us far above our long-term ability to sustain. And the good news is it catapulted science and research as well as income and consumption. And we're going to have to rely enormously on research and our inventiveness to save our bacon. And I do believe there is a decent chance that it will. Quite a number of years ago, I got into studying the rise and fall of civilizations. And I always like to recommend Immoderate Greatness by Ophuls, Ophuls. He's done all the heavy lifting for us. He's, in a series of chapters, condensed all the major reasons for civilizations failing in the past. And he's read everything. He knows it like the back of his hand. And it's like the Cliff Notes, very, very serious, well-written, quotable Cliff Notes on civilizations failing. And he gives 5 or 6 major reasons, which include overburdening the local environment, your soil, and your nature, and your water. Complexity, which is very energy intensive, and so on. And he concludes 2 things. One, that the current global civilization checks off every single one of them, which is rather creepy. And 2, that humans appear to be hardwired to self-destruct. And my take on that is that, like every other organism, we've spent a few million years fighting for survival, and we have learned to grab what we can when we can. And like other organisms, to grow, we propagate basically as much as we can for our first few million years. And we'll expand to fill the space available. And we are not programmed to think about long-term, slow-moving consequences. And so we don't. And we have to look at things today, like the president of Brazil encouraging the greatest deforestation in Brazil's history in the last 12 months, to everybody's shock. But we also have to live in a world where President Trump was doing his best to undo all the good that EPA and environmental movements had been trying to do. It's pretty bizarre to have a couple of serious countries attempting to ignore the greatest threat, perhaps for hundreds of years. And I believe that we do have some escape clauses from Mr. Ophuls' prediction of self-destruction. And that is twofold. One, unexpected by everybody, including Malthus in 1798, we are choosing, despite getting wealthier, we are choosing to have fewer children since 1961. It's a remarkably unexpected outcome. It was not predicted, as far as I'm aware, by anybody, let's say as recently as 1950. And the degree and the speed with which fertility rates are contracting is not really appreciated by anybody, including the financial community. We are not only way down from replacement rate in every developed country except Israel, but we are, if anything, accelerating. And so in the US, we're at 1.65 versus 1.21, 1.2 for 1.2.1 children. We're at 1.65. And so way down, a quarter below what is necessary. And many countries in Europe, Italy, Hungary, are way below that. And of course, in the Far East, you culminate in South Korea, which has incidentally overtaken Japan in individual wealth, individual income, I should say. They have a fertility rate below 1. I mean, it's just inconceivable. And China, Japan, Taiwan are all down there at the 1.5 level. Quite remarkable. And this is not a sufficient condition to save our bacon, but it is a very necessary condition. The other factor is the speed of our science and the fact that, if anything, it seems to be maybe accelerating. And we do have some getting out of jail free cards, thank heavens. The problems we face basically are all the cures so far have been contained within a finite world. We're trying to compound on a finite planet. But the get out of jail free cards have a whiff of the infinite. And they are fusion, a source of infinite energy if we can pull it off. It's green, we never run out, and it may be cheap. It remains to be seen. I'm reasonably optimistic, but it's certainly far from a probability of 1. Geothermal, the ability to drill several miles down and tap the heat of the inner core, which is more, for all intents and purposes, infinite and green. And we have a vast learning curve from fracking to tap into, but there are massive problems of dealing with the heat several miles down, but not necessarily problems that we won't learn to handle. And the third one is a major breakthrough in energy storage to go with the spectacular progress of solar and wind. Again, year after year has outperformed early forecasts. If you look at the International Energy Authorities and others, you will see an almost laughable pattern where each forecast for 2030 has been below the actual. Each year it's ramping up. It's like an investment model that never learns from the past, it seems. But if we can take the cost of energy storage down to 10 cents or 20 cents on the dollar from today and blend it and mix it with solar and wind, that will also be basically an infinite source of green energy. So I like to say, in all probability, the lack of cheap, available green energy is not the factor that will bring us to our knees. The problem is the time it will take to get there. We have wasted arguably 50 years getting the point that climate change is ultimately dangerous. And by the time we have all this cheap green energy, an enormous amount of damage will have been done. And the parts per million in the atmosphere will have gone from what we need, which is about 280 to 300, where you get a very stable world. It's currently 420, and it is on its way for sure beyond 500. This is the kind of burden that we will have to deal with. And if we have fusion or one of the others, we will be able to set about the slow, steady business of subtracting carbon dioxide and returning the planet to a decent state. So if we have that and we combine with a declining population, we really do have a chance of survival. As I like to say, we are, thank heavens, a very inventive species. And our foundation for the protection of the environment has a target of 50% green venture capital and 25% other early stage venture capital. The world is getting behind the need to green the economy, getting behind the need to be frugal with resources and change and improve the food structure. The governments are getting behind it. Corporations are getting behind it. Why would early stage new enterprises in those areas not be a candidate for highest return on the planet? I think they are. And it's thoroughly exciting. It gives a sense of purpose, and it may very well be the best investment you can make. The top line revenue of people going to solve climate change is going to dwarf the rest of the economy. It's the top line of electric vehicles versus the top line of the old vehicles, the top line of electricity versus fossil fuels, the top line of efficiency versus business as usual. That's where the growth will be.